If an entrepreneur or a business owner is thinking about going to market, start right now.
Knowing your business is ready to sell is really understanding what you want to get out of the deal.
The M&A process in and of itself is like fishing in shark-infested waters with falling swords. There's so many landmines, there's so many things that you have to consider. Welcome back to the Legacy Advisors Podcast, the show where we help entrepreneurs and business owners scale, acquire, and exit the right way. I'm Kris Jones, and with me, as always, is my co-host, Ed Button Jr. Today, we're diving into one of the most exciting and misunderstood aspects of entrepreneurship, M&A. That's kind of our shtick, isn't it, Ed?
Mm-hmm. That's for sure.
Buying or selling a business isn't just about shaking hands and signing paperwork. It's a high-stakes chess game where timing, strategy, and preparation make all the difference. Whether you're thinking about selling your business, acquiring a competitor, or just want to understand how the biggest deals get done, this episode is for you. So let's kick it off with something we're going to call Deal of the Week. And so when I was thinking about this particular segment, I just couldn't get TikTok out of my head, right? U.S. government in the Biden administration tells TikTok they have a certain amount of time to find a U.S. buyer or they're going to shut them down. Turns out Biden lost, Trump comes in, and Trump is also applying pressure, but he is more focused on this merger idea, maybe even with a U.S. stake. So there's a lot going on here. The clock is ticking for this thing to happen. And my question for you is, who are some of the players or who are some of the likely suitors that might step up to the table and make an offer for TikTok?
Yeah, so it goes back to even before the Biden administration, when the initial Trump administration was there. Microsoft tried to do it in 2020. I'm sure they're going to be a key player in the outcome this next round. You have Meta, Google, Mr. Beast, Mr. Wonderful, and they're all giving numbers between 20 and 50 billion in offers. You have Elon, you have a bunch of different options out there. It's a super complicated issue, and not really sure how it's going to shake out from a value standpoint. What do you think something like this is worth? 5, 10, 15 times revenue?
It's a great question. What is TikTok worth? Well, I'll say this. It's a super strong brand. I'll go off and say that it's probably the strongest tech brand right now, not named ChatGPT. And its algorithm works, right? The problem is that this is not a traditional M&A transaction, which we'll talk about in a second. So there are some things we don't know. One of the things we're not certain of is whether or not the Chinese government is going to actually sell the algorithm along with the brand.
Because that's ByteDance, correct?
ByteDance, yeah, is the parent company. But let's not forget, the biggest concern here is that China is sitting there sort of influencing what ByteDance might do in terms of collecting data. So yeah, I was thinking, Instagram was bought for like 100 times revenue. The most recent data that I could come up with was 2023, and they said TikTok made $16 billion. Go ahead and do a 100-time multiple on that. So I think what happens here is probably if the algorithm isn't involved, you are probably looking at a 10, 20, $30 billion transaction. But if that algo is included, I think that this could be a multi-$100 billion transaction.
Yep. And the other level too of it is it going to be involved with the government? Is it going to be a government-backed entity? Is it going to be sovereign wealth fund newly created that it might be to help promote it? I don't know who could invest and who could afford that risk of not having an algorithm involved.
Yeah, I don't know. And by the way, the idea that like Kevin O'Leary and Mr. Beast, that all feels like a stunt. Yeah. You didn't mention Elon though. And if Elon, it sounds like he might join forces with Larry Ellison of Oracle, but like with everything that's going on with Elon and the U.S. government and I don't know how we could possibly.
Well, there's another cool level to that one too. Is Oracle is already hosting the American data for TikTok. So he already has interest in it.
Good point.
So
Good point.
he's kind of already got his toes in the water, and they're two very well capitalized guys to get out the money if they need to.
So, coming back to this idea of M&A, though, being the overrider, this deal's unique in a lot of different ways. What are some of the things that make this particular deal stand out?
Really, I mean, like I mentioned earlier, it can either be a large tech company, other social media platforms. It could be private equity. And the most out-of-the-box idea is the government-backed entity, private equity type of thing. I'm not sure how I feel about it, really, because the CCP, China, the largest business in China for a reason.
Yeah.
I don't know if we want to go down that path in America, because capitalism is the ultimate check and balance in the business world, and the roller coaster of changes of in 2018, Trump wanted it sold, shut it down, get rid of it, get it out of the United States. Then the Biden administration came in, they aligned with Trump's initial value of saying, hey, get rid of it, get it sold, get it done, we want it all done. And coming into this election, now it's completely changed again of, well, maybe we don't really have to sell it. Maybe we figure out a way that we can bring it in here and control it. It's just a really big issue, really big topic. I mean, it collects a ton of data, and from everything, not just you, from your surroundings, from what you have in your background, and it reports a lot of that. I personally don't have it. I actually had it probably 8 years ago, and I used to watch stupid stuff on it. I was like, this is really addictive.
When it was music, when it was musically, or
it was music, and it was they had a lot of construction videos actually.
no, the app prior to TikTok was called Musically.
Okay, Musically, yeah.
Yeah.
No, this was still TikTok then. Okay. This was a while ago, but yeah, I mean, the ban to not to ban is really the question of, can we bring it in? Can it be of value to the American people? And because there is a ton of businesses that survive off it. A lot of American people.
Small businesses love it. And honestly, I think that I'm a digital marketer. I've been doing it for a long time, and I'll tell you what, I think it's super innovative. They have done for social commerce what QVC and the Home Shopping Channel did for television. They did that for e-commerce, and it's unbelievable that they're, so.
Yeah, and it's very hard to replicate. YouTube's tried to do it with the YouTube Shorts. Hasn't caught on. I mean, it really found its own niche, and it locked a lot of people down. So what do you think is going to happen next with it?
It's a good question. I think that the most likely scenario is that TikTok is sold to a U.S. buyer. And again, I'll go out on a limb and say that the algorithm probably won't be included because of those geopolitical issues that you were talking about earlier. The other thing is that the parent company, ByteDance, could try to spin TikTok off in an effort to kind of, slow the process down or complicate it. Another thing they could do is just use our court system. I mean, if you want to watch paint dry, all you got to do is file an action in the U.S. courts. So that could kind of punt it. But the problem in the presidency of Donald Trump is probably highly unlikely to let anything happen here that doesn't protect U.S. businesses and users, but also removes China from the equation. So a U.S. buyer is likely to come in. All right, let's dive into the second segment, which is this idea of the M&A Masterclass, right? And we could use this segment in future episodes to really dive deep into various processes of M&A. Today we're going to talk about due diligence. And, due diligence is one of those things that I like to refer to it as sort of like a proctology exam, if you don't mind. It's the opportunity for the buyer to come in and dig as deep as they want, wherever they want, if you will, to make sure that the investment that they're making is they try to de-risk it. I thought we'd start with sort of sharing a story. where the due diligence process just went sideways. So for me, it was when I was selling my first company, Pepper Jam. The initial buyer was GSI Commerce, publicly traded company on the NASDAQ. The CEO at the time is now a super famous guy by the name of Michael Rubin. And Michael Rubin invited me down to...
For the white party.
No, he didn't invite me to the white party, but he invited me down to Philadelphia. And for this instance, I took like 12 to 15 people from the Pepper Jam team. And it was pretty much meet and greet. Like there was beer, there was all this stuff, and it was just basically a party before we actually announced the sale. And Rubin's CFO, Michael Kahn, who was a great guy, said, "Hey, Kris, do you have 10 minutes? And I'm like 2 drinks in at this point. And he calls me into his office and he pulls out our most recent financials and says, it seems like you're trailing, what you guys are projecting. Are you going to hit your numbers? And I was like, well, we're going to die trying, or we're going to come real, real close. And, long story short, he tried to open up the opportunity to renegotiate the deal, the terms. And I don't question his motivation. I think they were just doing their due diligence. Are you going to hit your numbers? He's probably trying to feel me out. But in that moment, he did try to renegotiate the terms. And what he threw out, I think for other founders might have really set them off. I didn't allow it to set me off. And when we renegotiated, all I did was move some of our payout into performance. And guess what happened about a year after the acquisition? eBay came in, bought the company, stock went up 50%, so it's all good. But it was really, really close to derailing the deal. Do you have any stories like that?
Yeah, I was on the other side of it actually. So I was on the buy side, and we were doing a transaction with a freight business. And get all the way through the APA negotiations, really get into the deep due diligence. And a lot of the value of the business is on assets in that space, meaning trucks, tanks, things like that. So we basically propped up this whole APA on the value of the vehicles from a finance perspective, from a de-risk perspective, and all that stuff. Well, the value we placed on it, which was what we expected to be market value, and OLV, or liquidation value, it came in about 30% lower.
Okay.
So, unbeknowingly, I got very creative, figured out a way to get the deal done, and it's not nearly as exciting to go into the white party of Michael Rubin, but yeah, it was a curveball thrown at us. We still got the deal done. Now, if you ask me 5 years later about getting the deal done, I should have maybe took a step back and not been the young bull. We're gonna get this done no matter what. But yeah, it was definitely a curveball, and it almost derailed the whole deal. But we got it back on track.
It's one of those things where, if you think through every due diligence process you went through, it seemed like at some point something happens that's unexpected and feels like it could derail. So one of the things I like to recommend to people is to plan ahead. So if you'd be thinking about, I'm talking to anyone that's listening in or watching, if an entrepreneur or a business owner is thinking about going to market, start right now preparing for that due diligence process. At a high level, making sure that your books are in order, that you're in the process of reviewing those books, your balance sheet, your cash flow statement, your P&L statement on a monthly basis. Familiarize yourself with the trends, the history, everything that's going on with your financials. Honestly, in terms of prep, if you have a part of your business, I like to call it sort of like the dead dog part of your business, the one that is really dragging on your profits, and just no matter the effort, you just can't turn it around into a profit generating piece of your business. In the prep stages, not while you have deals and you're in due diligence, but anticipating that, it would be a good time to think about cutting some expenses. Similarly, if there's anything that a buyer might get startled or find out that is just, potentially hard for you to explain, I like to say it's like skeletons in the closet. It's better to address that now.
Yep.
So those are just a few of the things that folks could do.
Yeah, and I mean, to build on that, really, there's a lot you can do. One thing you got to remember going through this process is you still have to run a business while you're doing all this. So one thing I always tell everybody is continue to run your business as if you're not even thinking of selling it. So you want to make sure your fundamentals are in place. You want to make sure your accounting is done and clean and up to speed. Like you said, you want to block and tackle on those skeletons. Make sure you get out in front of it. Make sure you're transparent with it, because they're only going to come back to you. Most of the acquirers are professionals, and they're looking to really de-risk the whole situation and understand everything. So the real big question, Kris, that comes into play is the seller stay. So to build some color around this it's probably one of the biggest decisions in your life you're ever going to make. It's something you could liken it to children. You're building something from nothing to something, and you have no clue if somebody else wants it. So how could we work through kind of discussing the seller stay? Do you want to do a hypothetical option?
Yeah, let's talk about it. I mean, so many things come to my mind. One of the things is timing, but yeah, let's do that. You want to give us a hypothetical, then we'll pick sides.
Yes.
I'll do the stay.
Okay.
So I don't want to sell, and I'll tell you why.
Okay.
And you can make the argument around why you should sell.
Okay. So take a $10 million a year revenue SaaS company. So software as a service, good recurring revenue, been in business for 5-6 years.
Okay. Compounded
Annual growth rate of 30%. And you have an offer on the table of 5 times revenue. Why are you staying?
Well, I mean, the 5 times revenue on 10 million. So you're talking about a $50 million transaction.
Yep.
I'm going to assume that I own 50% of the company. 25%, last time I checked, 25% of 50 million is fuck you money.
Yep.
That's a ton of money.
Yep.
But if I stick with it, and if I focus on growing, because I think you said growth rate's about 30%.
Yeah, it's at 30%.
Think about that. You're going to be doubling really every few years in terms of your size. I'm young, my kids are still young. I'm not going to be missing their sports activities and stuff for at least 5 years. I'm going to give it another 5 years. And instead of it being a $50 million, this puppy's going to be $150 million. Why would you sell?
So I would look at primarily my own life, where I'm sitting at in that time, that place. And from a family aspect, from a life aspect, from additional opportunities aspect, if it was me in this current situation, my kids are getting into the sports now. This is their first year of baseball and t-ball. I want to be there to witness it. I would evaluate whether how much shoulder needs to get put in to make it that $150 million business. And also, too, it's growing at 30%, which is great. But with you having, say we're in the same situation, I own 25% of the business, or 50% of the business. Your money's growing by 30%, but is there other options out there? If it was me, I would look at it and say, hey, this could be a potential reset. $50 million, even at 50%, you're clearing $25 million. That's going to be a crappy tax bill to pay, but it's a worthwhile tax bill to pay. And really looking at owner fatigue, growth plan, and understanding the scalability. And then the competitive landscape. How's the competitive landscape changing? And if I was able to check all those boxes in the sell, that's when I would sell. But going through the process, that's how I would get to my decision on sell or stay. And I think with this one, I'd probably sell.
You'd sell, yeah. I'm still stuck on the timing. It's one of those things where if you mistime it, it's probably going to be one of the worst decisions of your entrepreneurial life. I find this happens a lot with family-owned businesses, particularly with legacy advisors. The reason that we use the word legacy is that it's on the line. right? So you don't want to mistime it. One of the things I also, this is just kind of like my opinion, is that if the founder, this happens in family businesses where everybody's doing well, but nobody's like super, super well off. So they misjudge how much money is a lot, right? And you get kind of caught up in like, almost like vanity numbers. Like if it was 20 million, I would do the deal, but at 15 million, I won't. So there's timing, there's a lot to it. And I think one of the reasons I like this segment is because this is part of what you and I bring to the table for founders as they're thinking about this. I mean, I just was in the last week or two, I remember doing a call, you and I were doing a call with a prospective client, and there was like 4 or 5 stakeholders in the room. Like 3 of them were family members. You know, it's a different answer sometimes about the timing question for the different people. And like I said, if they haven't accumulated wealth yet, you know, and we sell now, and that number that you get isn't going to be big enough, whatever that means, there's a lot of considerations. And it's one of the things that I think most about with M&A is timing. And I want to make sure that our clients are able to anticipate the market. I don't think it's about timing the top, you know, of the market. That's risky. But are there lots of buyers? You know, is it a market that is favorable in terms of multiples? Have other transactions happened in your industry? And again, all of that research and market research, call it or whatever, we also do for our clients. That's part of the value that we provide. Let's dive deeper into M&A with a segment where we look at the reality of it. It's, as I said earlier, you know, there's always this almost assumption that 1 or 100 things are going to go wrong, or at least be unexpected. And like we said earlier, we don't want to derail, you know, the process. So why don't we start with you telling us a story of a deal that went sideways?
Yeah, so this deal went really sideways to the point of we actually had to back out of the deal. It was a business south of here in the Allentown market, and had the APA done, had a lot of the due diligence done, and luckily, it was actually our accountant found it, there was an excessive amount of distributions going to the owner, and we just questioned it and said, what are these? Are these all add backs? Because we assume they're all add backs because they're distributions. And the owner came back with, no, there's actually about $325,000 worth of rent in that number.
Annually?
Annually.
Yeah.
That I still want to get after the deal. And this business didn't need real estate. The real estate that he was trying to rent out didn't need. And we tried to get him off his mark. And we're like, hey, we don't need that space. We don't need this place. We just need the equipment, the account list, the goodwill. We'll do this much, kind of as a good faith. Like, hey, this wasn't brought up early, and blew the whole deal up. Deal crashed and burned, and that's really where it landed. Yeah. And that one died. So you had one that died on you?
I had a near death, although it's just a really good story. So the guy that I mentioned earlier that bought Pepper Jam, Michael Rubin, the White Party, Michael Rubin, former owner of the Philadelphia 76ers. But at the time, he was the CEO of GSI Commerce. And I established a relationship with him and some of his executives. And it was probably a month into us discussing the prospect of them acquiring us. And I get a call from him and he says, hey, Kris, we'd like you to come out to King of Prussia and meet up. Just you though, you know, don't bring your partner, Mike. You don't have to bring anybody. So I thought it was going to basically be me and Michael Rubin, I don't know, you know, out for dinner. I mean, I told my wife, Robin, I'm like, you know, honey, I'm probably going to be home super late. You know, we're going to probably go out and have a couple of beers or whatever. But what happened was once I got to GSI's headquarters, They ushered me into this conference room, and I'm telling you, it reminded me of The Apprentice when that was on television. This boardroom table had to be 30 feet wide. And I'm like, okay. So they sit me at one side of the board table. On the other is Michael Rubin himself. You cannot make this up. I actually wrote an article on this that was published in Inc. magazine. If people are curious, they could Google it. But sitting across from me is Michael Rubin. To his immediate left is his CFO and his general counsel. To his right is his CMO and like one other person, and just me. And we
divide and conquer.
Yeah, and we do some like, back and forth, like how, how's the conversations going kind of thing. And honestly, all I could really remember from this meeting is silence and Michael Rubin looking me directly in the eyes and saying, Kris, what is your price? And I was like, oh, come on. 101 negotiating. You don't start with the price, but who gets an opportunity to have that FaceTime with Michael Rubin and his team? So I didn't want to give him the lowest number because that's probably going to be a high. I didn't want to give him the highest number because pigs get slaughtered, and candidly, it was a very good fit for Pepper Jam to get acquired by GSI Commerce for a whole ton of reasons we could explore later. And I literally blurted out an 8-figure number, and to me, it felt like there was just like brutal silence. And I swear to God on my life, he looked at me and he said, okay, cool. I think we'll get a deal done. That's all I remember about that board meeting. I remember driving home and I remember calling my wife and telling her about it. But I just felt the reason why it was
surreal.
Almost, well, not even surreal, but again, it's interesting. It's like Tony Robbins says, in your moment of decision, your destiny is shaped. Oh man, I have so many amazing stories of where I just had the guts as an entrepreneur to see my vision. When I founded Pepper Jam, I had this vision that I was going to eventually sell it to a publicly traded company. So when I was sitting in that room with him, I didn't want to fuck it up, And I look back on it like I am not making the recommendation to do what I did. And candidly, looking back on it, it very well could have been. It wasn't and shouldn't be, but it could have been interpreted as a bad decision. Because what if the number I gave him was a half or a third of what he was thinking? I mean, I was happy. I've done quite well. Anybody could look into my background and say, holy shit, this guy has really lived an incredible entrepreneurial life. But that particular meeting where we were in the M&A process, we were expecting an offer, and that happened. So anyway, let's move on to the last segment for today's podcast. One of the ideas we had, and we hope in the future to get some viewer submissions in terms of questions, but one of the best ways to learn M&A, because if you haven't gone through it, you literally have to study it, or you have to ask someone who's gone through it lots and lots of questions. So what I want to do from a production standpoint with our podcast is really ask each other lots of questions, because between the two of us, we've been through so many M&A transactions that we could share stories and et cetera. So this final segment is called the Deal Doctor, and we're going to dive into M&A Q&A. So first, how do I know if my business is ready to sell? We touched on this a little bit earlier, but any thoughts on that?
Knowing your business is ready to sell is really understanding what you want to get out of the deal. You could almost sell anything at any time if you're extremely flexible on price. Depends on your aspirations of the deal. Do you have a realistic number in place? Is the market in a growth or an acquisition stage? Is there money in the market to acquire? And specifically to one of the industries I play in, energy is extremely choppy on acquisitions. It really depends on the social and economic environment, to where some years you couldn't give stuff away. Other years you're going to get top of bid. And then really understanding and how you set your goals and structure your business and looking at it. Acquirers want rateability and durability in your business. So they want to know the business if you're planning to leave the business to where you're not involved after the transaction, after the closing, whether it's transition phase, 3, 6, 9, 12 months, whatever it is, or maybe 2 years. They want to know the business can run without you. So is the business only there when you're there? Or is it something that you're in and out, you have a really good staff, maybe a really good COO or CFO, somebody that's really holding down the fort? And how durable is the relationship with that person? Yeah. Can you structure that with a retainment bonus? Can you structure that with potential interest in the new co or the company that's acquiring you? And then it all comes down to really value. And the way we take our approach at Legacy is we do a bid process. We go through a couple stages.
Right way to do it.
And we really let the market delegate what the value is and then return it to the sellers and say, hey, this is where it came out. Because it's not like you're going to buy an Audi A4 or a G-Wagon or something like that. There's a price. And even then, going through COVID, market delegated prices on vehicles too, and houses. And it's supply and demand in the end. So really looking at how you value the business, how do you normally take that approach?
In terms of valuation, if in the tech sector, it could be based on non-traditional factors like the size of your database in terms of users. It could be the velocity of your growth. But traditional valuation is typically based on a multiple of EBITDA, earnings before interest, tax, amortization, and depreciation, and or revenue. And what they'll do is they'll look at your last, call it 2 to 3 years of revenue, and they're looking for what the story is. What's the annual growth over the last couple of years. And then the other piece of the process really to valuation is looking at future predicted earnings in the form of like pro forma. And so all industries, have other businesses that, it's almost like pricing real estate, where when you're trying to price your home or figure out what it's worth, they use comparables, like what are homes selling for in your area, kind of thing. How much square footage. Similarly, the way that you and I approach it is we do a deep dive, exhaustive, research on the latest transactions, and it's typically a multiple of either profit, EBITDA, or gross revenue. And one thing I will say before we go on to the next question is European, let's just put it this way, US valuations and European valuations, or even valuations. I have friends that have raised capital and have done some transactions in the Middle East. So depending on who your buyer is, they may look at, valuation differently. And from my experience, having raised money from outside of the US as well, they tend to be much more, in my opinion, much more aggressive, much more liberal, if you will, with how they'll evaluate, a business. So, all right, so if we're going through this M&A process, we've coached the founder, on making sure that the timing is right, like really listening to where they're at in their personal life and in their business. So we want to sell. How does someone go about finding buyers for their business?
Yeah, so there's a lot of different ways you can go about it. One way I'd recommend is you not dealing with it. Granted, we are in the M&A space. We make money.
But to be fair, like this can't be a pitch, because at the end of the day, right? In my opinion, I've been pitching the idea of hiring an M&A advisor for my whole career. I said in the first podcast we ever did, I said that when I met Tim Carmen from RBC Capital, that was a game changer. I learned so much. I got so passionate about the idea of raising venture capital, building businesses, selling them for millions. So coming back again, like how do you're recommending hiring a broker advisor kind of thing, right?
Not necessarily. Okay. It might not be a broker advisor. Might be your accountant. It might be an attorney that you're close with. It could be you setting up a small little group within your business that you kind of do the initial thought process with, and do some thought leadership around, hey, these are my confident people. I have confidence in these people that they're not going to spread it, tell it, they're going to keep it secret, and really kind of bounce the ideas off of them. And then once you do become ready with the decision, like we talked about in most of the podcasts of how do you even get ready with the decision, is I go back to the best way to understand and get the most value out of your business is first step would be looking at associations in your industry, groups in your industry, different areas that might have access to lists for private equity or strategic buyers in your industry. And then really what we would do from our aspect is normalize the information, bring all the information together, make sure everybody's working off the same information, and get a compiled list of potential people you want to go to that you have to be strategic about how you pick them and who they are. And then we run a bid process. That's how we do it. That's how I've done other stuff outside of legacy, is done a bid process to trying to get the max value. And
nothing drives valuation like FOMO.
Yep.
I should have said that earlier. How do you get you build demand, you build interest, and it builds.
And it only takes two. Once you get two people working against each other, you can achieve some better numbers. And there's also the other ones where it's just not the right time, and you want to find that out early before you go through the trouble of building everything. But yeah, I mean, from finding the list, going through agencies, talking to bankers, and a lot of this can be streamlined with, like you said, potentially hiring a broker or a transaction manager that already has the inroads in those areas. It can go really quick. A lot of times those people have trusted partners that they worked with in the past that they might have sold 1, 2, 3, 4, a dozen other businesses too, and they know this package coming out is going to be the adjusted EBITDA is correct. They're not overstating anything like that. They trust the information. So yeah, I would go back to mainly just getting a lot of fishing lines in the water and looking to get as many fish hooked as possible.
The thing that I love about your response is that, to the way that I think about it, it's contrarian in that you're suggesting that, the entrepreneur, the founder could start taking these steps on their own. The thing I love about it, though, is that process, and we all field, if you have a successful business, you likely field emails or calls from people who say, I want to buy your business.
Yep.
I have a rule that I started back before I ever sold Pepper Jam, because I've always been like a financial geek and I love it. And I had a policy. It was an always take a call. So Maggie, who was my HR, and she was my front desk for a period of time, she would take the calls, and she knew that if this was a venture capitalist or whatever, that she could move the call into me. And it was through that educational process with RBC Capital, and then later, just by taking those calls and discussing it. The problem, though, is there's a bit of a trap. It's an emotional trap. It's totally, think about it.
Yeah, you got to keep a cool head through the whole process.
Dude, I mean, entrepreneurship is full of emotion, and to be able to separate it is so hard. We've already described the due diligence process, but the M&A process in and of itself is like, fishing in shark-infested waters with falling swords. Like, there's so many landmines, there's so many things that you have to consider. That's why I always side on, bring a professional in. And by the way, one of the things you alluded to earlier, but we didn't dive into, and we will in the future, because it's a huge part of the M&A process, is negotiation. But again, there's a conflict of interest on the emotional side. You're much more likely, if you're emotionally charged, to say no at the wrong time, and possibly to say yes at the wrong time. And at Legacy,
or get frustrated and piss off the other side at the wrong time.
Absolutely. Oh man, I've got stories where you thought you said the wrong thing. Is this gonna kill the deal?
You got the
but yeah, that's M&A. At the end of the day, is that's why I love it. I love the strategic side of it. But with that, this episode is over. Thank you so much for watching and listening. We look forward to seeing you in episode 3.